Welcome to this explainer. Today, we're diving straight into a really fascinating investor pitch that breaks down ServiceNow's massive pivot into enterprise AI. We're going to look at how they're positioning themselves not just as a handy software tool, but literally as the foundational AI control tower for the modern enterprise.
Let's kick things off with a massive question that this pitch uses right out of the gate to frame the whole conversation. Think about this. If you could only pick one company to bet on for the next decade of enterprise AI, who's it going to be? The source material sets up this really stark contrast. Do you go with some legacy software giant that's currently scrambling to play catch-up? Or do you choose the company that's already the digital backbone for the world's biggest businesses? It's a killer hook, right? And it perfectly sets the stage for their entire argument.
And to really grasp how strong that digital backbone is, just look at this staggering number, 85%. That is the percentage of Fortune 500 companies that are already using ServiceNow as their central nervous system. As the pitch points out, this isn't just another software stock. No way. They already have their foot in the door and are deeply embedded in the day-to-day operations of the most critical enterprises on the planet.
All right, so here's our roadmap for today's explainer. We'll start with the enterprise backbone, move on to the AI control tower, tackle the valuation debate, and finally wrap up with the overall investment thesis.
So jumping into part one, the enterprise backbone, we really need to look at the foundation of this company and how they've grown way beyond their original mandate. You know, ServiceNow actually started out as just an IT service management platform, basically the operating system for how companies manage their technology and help desks. But they definitely didn't stop there. Over the last 5 years, they've executed this aggressively successful expansion into pretty much every major corporate department. We're talking human resources, customer service, finance ops, and all the way through the supply chain. They are literally weaving themselves into the very fabric of how these massive companies operate every single day.
Now, you might be wondering, why does that broad departmental reach actually matter? Well, because of this incredibly deep workflow integration, their net revenue retention consistently tops 110%. In plain English, once a company adopts ServiceNow and puts it at the center of their operations, they rarely leave. Actually, scratch that. They don't just stay. That 110% figure means existing customers are actually spending more money with them year after year. For anyone analyzing software, this is basically the holy grail. It's an incredibly sticky ecosystem.
And the pitch argues that these financial milestones prove this is about pure execution, not just AI hype. Look at this. 22.5% subscription revenue growth recently, with operating margins sitting comfortably north of 30%. But the real kicker? They just crossed the $1 billion mark in AI-related annual contract value. The source highlights that the market is definitely noticing this execution. They point to a recent partnership with Tech Mahindra as a perfect blueprint for taking AI out of the pilot phase and putting it into full-scale production across global enterprises.
Okay, moving on to part two, the AI control tower. This is where ServiceNow really starts to separate itself from the rest of the pack.
Here's the crucial thing you need to take away. They aren't just selling another chatbot. They are selling the governance layer for enterprise AI. Listen, large enterprises are absolutely terrified of AI chaos. They do not want dozens of disconnected, random AI tools running wild across their networks. So ServiceNow's solution is this AI control tower. It gives companies a unified, fully auditable, single pane of glass. It lets them deploy AI agents safely, monitor performance, and ensure strict compliance. It's a massive competitive moat built entirely on security and oversight.
What's really fascinating about this strategy is perfectly summed up in this quote from the pitch. ServiceNow wants to be the AWS of enterprise AI. Think about that for a second. They don't want to just be another application layer sitting on top. They're aiming to be the foundational infrastructure underneath the whole shebang, just like Amazon Web Services became the absolute foundation for cloud computing.
And driven by this huge wave of AI adoption, their financial projections are taking a massive leap. Right now, they're sitting at a run rate of roughly $15 billion. But by 2030, they are targeting $30 billion in subscription revenue. They're basically planning to double their current run rate, with AI expected to drive a huge chunk of that growth over the rest of the decade. The runway here, at least according to the pitch, is just enormous.
All right, let's pivot to part three, the valuation debate. We absolutely have to ask, is this stock priced for perfection, or does the current price actually make sense given these wild goals? The source material doesn't shy away from the reality here. The stock has had an incredible run, and, historically speaking, it is expensive. It's currently trading at about 78 times trailing earnings and roughly 31 times forward earnings.
But the pitch argues that when you actually factor in the projected earnings growth over the next 3 to 5 years, you have to look at the PEG ratio. Because the PEG ratio accounts for that rapid growth, the pitch claims that through this lens, that premium valuation actually starts to make a lot of sense.
But we need a reality check here. We simply can't ignore the competitive landscape. I mean, other massive software players are fighting tooth and nail for those exact same enterprise AI budgets. Everyone wants a piece of the pie. Giants like Microsoft, Salesforce, and Atlassian are all dumping heavy investments into their own capabilities. But the pitch insists that ServiceNow's true advantage isn't just the shiny new AI tech itself, it's those deeply embedded customer relationships and workflow integrations we talked about earlier. Every dollar spent on ServiceNow is meant to save multiple dollars in operational efficiency. To keep things completely objective, we have to weigh the risks against the strengths. On one hand, the bear case points out some very valid concerns. Execution risk is real, macroeconomic uncertainty could easily put the brakes on overall IT spending, and as we just said, competition is fierce. But the source argues the bull case is ultimately stronger. They point to ServiceNow's unmatched pricing power, that incredibly sticky recurring revenue, and a super clear path to becoming the default governance platform for enterprise AI. Which brings us to part 4, the investment thesis. Let's wrap this up by looking at the final verdict drawn by the source material. The investor pitch concludes that ServiceNow absolutely isn't some speculative AI play. They see it as a proven market leader riding a massively diversified trend. Their thesis really comes down to 3 pillars: revenue growing at over 20% annually, margins actively expanding as AI automation cuts internal costs, and the fact that the market historically loves recurring high-quality revenue. So what's their final recommendation? Impartially reporting here, they recommend accumulating on weakness, betting that the long-term trajectory is rock solid and the execution will be flawless.
I'm going to leave you with this final, really provocative thought directly from the pitch to mull over as you evaluate the future of enterprise software. If AI truly reshapes every major industry over the coming years, who controls your enterprise? Are you going to rely on a patchwork of disjointed tools or a centralized control tower? It's a fantastic question, and it gets right to the heart of ServiceNow's strategy. Thanks so much for joining me for this explainer, and keep an eye on these incredible technological shifts.